Assalamualaikum and a very good day to all viewers and students out there. Thank you for coming to my channel. Today we're going to have a lesson on the preparation of financial statement, and this is on the preparation of consolidated statement of profit or loss and other comprehensive income. And we're going to do one illustration, complete illustration showing how do we prepare the consolidated statement of profit or loss and other comprehensive income step by step. And if you see here, as I mentioned in my lecture in my previous video, there were three possibility that the company will be acquired in terms of its dates of acquisition. So for this question, I'm illustrating that situation using question FAR320, which is suitable for our situation here, December 2016. And if you look here, AIDIL GROUP acquired 70% of the ordinary shares and 30% of the preference shares in Fitri, that is the subsidiary company. Subsidiary company is Fitri on 1st of January 2014. So therefore, 1st of January 2014 is the date of acquisition. And what was acquired is the 10% preference shares, which is 30%, and the ordinary shares. Ordinary shares that were acquired is 70%. So that happens on 1st of January 2014. And this is the date of acquisition which happened to be in the prior period. Why? Because the reporting date of the company is here, 31st of December 2015, and the company has acquired the subsidiary 2 years ago, 1st of January 2014, which is in the prior period. So if this is the period, let's say here, so this is 31st of December 14, it was acquired here, 1st of January 14, the date of acquisition. And this is the prior year. This is the prior year. And this is the current year or the current period. And this is our the current financial year end or our reporting date. Okay, we will prepare our statement of profit or loss and other comprehensive income here. So that is the situation. And on that date, the retained profit of Fitri, which is the pre-acquisition profit. So we have the pre-acquisition profit, and that pre-acquisition profit is 300,000. So that 300,000 is available on 1st of January 2014. On the acquisition date as well, the land of Fitri had been revalued. Okay, before we go further down, let us just look at the requirement so that we know what we are required. For your information, if you look at the question, it consists of 3 parts, but I'm not going to do the first part because for FAR320, the marks allocated for the preparation of consolidated statement of profit or loss and other comprehensive income is 30 marks. So we are going to do this part and this part. We're not going to do the theory part. You can try and do it on your own referring to the textbook, right? But we're going to do part B, which is to prepare the statement of profit or loss and other comprehensive income. And part C, which is to prepare the consolidated statement of changes in equity of the group and its subsidiary, Fitri Berhad. And our focus when we prepare the statement of changes in equity is just to show the retained profit column and the non-controlling interest column. We're not going to prepare the complete statement of changes in equity. We're just going to prepare the so-called the extract statement, which is part of the statement only. Okay, that is what we're going to do. So let's look at the question now after you know the requirement. So you have this information that there was a fair value adjustment for land of Fitri that happened on the date of acquisition. So this has to be incorporated on the date of acquisition. So that will affect the calculation of goodwill. However, in this question, you would be given the information on goodwill. If you check, that was information number 4, where the goodwill on acquisition of Fitri is 300,000. So you do not have to calculate the goodwill, only that you are informed it is impaired by 8%. So impairment of 8% were not informed whether that was impaired in the prior period or in the current period. So therefore, we will assume this is impaired in the current year, which is 31st of December 2015. So because we were talking about goodwill just now, right? Then you have the land that was being revalued on the day you acquire the subsidiary, and this has not been incorporated. So we have to incorporate this land revaluation as we prepare the 2 statements that is required, the consolidated statement of profit or loss and the consolidated statement of changes in equity. So you would recall perhaps the other comprehensive income will be the revaluation surplus, where you would see this is the fair value and this is the carrying amount, and land is not depreciated. So the difference between 300,000 and 1 million will be the revaluation surplus, and this is pre-acquisition revaluation surplus because that happened on the date of acquisition, and that must be incorporated in its account. So that has to be adjusted later when we prepare our consolidated statement of changes in equity, because that revaluation surplus happened in the prior period, which is on the date of acquisition. You need to also check if the other comprehensive income here, does it happen also in the current period. One more important thing is that you need to also know whose assets are being revalued. Is it the parent or is it of the subsidiary? In our case here is the one of subsidiary, Fitri. So these are the statement of profit or loss and other comprehensive income, a separate statement that was given for you of AIDIL, the parent, and Fitri, the subsidiary, for the year ended 31st of December 2015. This is not the consolidated statement of profit or loss, but this is the separate or the standalone statement of each individual company before we consolidate them. So what you need to do is you need to prepare the statement of profit or loss, the consolidated statement. So it's just the similar procedure as I've mentioned. You're going to combine line by line. So combine the line item according to the one of the subsidiary and plus the one of the parent. So you're going to add the expenses and income of the subsidiary to the one of the parent. And bear in mind, you must eliminate the intercompany transaction, or any intercompany transaction here could be any intercompany income or intercompany expenses. So if there are any intercompany transactions that have been included in the preparation of the consolidated statement of profit or loss, so that is not supposed to be. It has to be excluded, right? So it has to be excluded. You only report the income and expenses of the group, which is the parent and the subsidiary, to those that relates to the external party or those of the outsider, right? So the first thing that you need to do is to understand that we need to combine. So we're going to do the combination, and that is going to be something like this, right? We're going to have some template being done. So our first part, for example, in this question, it talks about turnover. So you're going to have the turnover of the parent plus the turnover of the subsidiary. So I will put here, this is the one of the parent. In our case here, parent is AIDIL, which is the parent company, AIDIL. I put here H. H is holding. And this one is Fitri. Fitri is the subsidiary. And I put the S, right? And the adjustment that you need to include here is normally is the one relating to intercompany transaction. So you're going to do this first. So let me just do it with you. Okay. We do it side by side, so it's easy for you to have a go. Okay, let's just make some adjustment here. So here is our question. Okay, here you have the question with you. So let's just look at what we have here next to each other. The first thing before you start is to make sure that when you consolidate 100% of the income and expenses. Let's say for Fitri, it is 2.6 million. Regardless, you acquire the shares in the subsidiary company for just 70%, you are going to add or have the full consolidation of the income and expenses. As long as in the current year, you have acquired, in our case here, our current year, you have acquired the subsidiary for more than a year or at least a year. So here in our case, we have acquired for 2 years. So in the current year, we will consolidate the income and expenses in full, right? However, if you come across a situation where in the current year, you do not have you have not acquired the subsidiary for at least a year, let's say for just 9 months. So therefore, this will need to be time apportioned according to the month that has been acquired. But this is not in this question. So we're just going to simply add here. We're going to simply add what we have, which is to add the subsidiary and the one of the parent. Okay, you are adding 3 million with 2.6 million. We are not doing any adjustment for intercompany transaction yet. So you can do the same for your cost of sale. And then you repeat again the selling and distribution. So just copy that and put it there. You will be doing the same for the expenses. Just add the 2 expenses of the parent with the one of the subsidiary. And the item that you have, the next one is the finance cost, but I have somehow rearranged. I put the finance cost right before the profit before tax because that is supposed to be after the operating profit. And you have one item here, preference dividend from Fitri. For your information, the preference dividend that you receive from Fitri, which is from the acquisition of the 10% preference shares, there is one important note that was given or important additional information given in the question. So let's look at the information here, which is number 6. So at the end of the year, you are informed Fitri paid the preference dividend. So those are not so much related to the types of the shares. It was just the dividends that were for the preference shares. However, the second sentence says the preference shares of Fitri have fixed rate of dividend. So of course, the preference shares has fixed rates of dividends in most cases. And here you have one more important word, which is mandatory. So the word mandatory means that is going to be the case of redeemable preference shares, where you have to repurchase the shares back from the preference shareholder when the date is due. So these types of preference shares that were acquired by the parent in Fitri is redeemable preference shares. So just recall what you have learned before. The redeemable preference shares, the dividend related to it is a finance cost. So if there are any dividends that were declared, the dividend is declared before you arrive at the profit before tax. So the dividend are not declared out of profit for the year, but that was actually similar to the nature of debenture interest. That is part of finance cost. So if Fitri has already paid the preference shares dividend, that has already been included here in the finance cost under Fitri's column. So we need to know how much. To know how much is quite easy. You just need to use the percentage of the shares, right? And the percentage is 10%, and you will be able to know how much is the dividend. So I'm just trying to take your attention to the information on the preference dividend. These are intercompany transaction. However, before we go and eliminate, I just simply put that first. So here you can see these are the intercompany transaction, but we will eliminate later. Same goes for the professional fees. Professional fees is also an intercompany transaction because that was the one that were received from AIDIL. So Fitri received from AIDIL, so that was an intercompany expense to Fitri, sorry, to AIDIL, but it's an income, intercompany income to Fitri. So that has to be eliminated later, but now we are just combining first. And then you have the item taxation. For the finance cost as well, it's the same thing. You have the finance cost. I just add up the finance cost. I will later eliminate the intercompany transaction that contains in the finance cost, which is the dividend. So this will later be eliminated with the intercompany dividend, which is this 30,000. So you will see later this will be removed. But we are now doing the combination. Same goes for the income tax. Okay, you have done with the combination part. You will have to do now the additional information. Okay, let's look at the additional information for each of the item. Before that, you have the taxation information that you just need to add. But in our question here, we do not discuss on deferred tax. This is just focusing on taxation. Statement of changes in equity for the year ended 31st December 2015. This is the separate statement of AIDIL, the separate statement of Fitri. This is the statement relating to the retained profit column, But for the requirement of the question, we are going to prepare not just the one related to a retained profit column, but also those that contains the non-controlling interest section, right? So these are the information that you have, the retained profit brought forward and up till retained profit carried forward. So let's look at the additional information number 1. Additional information number 1 is on surplus of revaluation. So if you look at the surplus on revaluation, that surplus happened in the current year. So why do I say in the current year? Because that was happening on 31st of December 2015. So if it's 31st of December 2015, look at who is the company. Which one is AIDIL Berhad? AIDIL, right? So that what we're going to do is we're going to do this consolidation adjustment just to let you do it here. So land of AIDIL and the surplus was 200, and this is the one that happened in current year. So therefore, in terms of journal entry, you will have to debit land, of course, land of AIDIL, the parent, and you will credit the revaluation reserve, ARR, of also the parent AIDIL. How much? By 200,000. But in terms of the impact in the consolidated statement of profit or loss, when you credit land, that will be under your other comprehensive income. So in the other comprehensive income section later in your Sopl, you are going to add the 200,000, which is the surplus of the revaluation for AIDIL, the land in AIDIL. There is no need for you to adjust the depreciation. So that will be done in our consolidated statement of profit or loss. Number 2 is on information on preference dividend that were proposed by AIDIL. AIDIL, remember, is the parent company, and what was proposed was 80,000. And the preference shares in AIDIL, even though that was a preference shares, it has no fixed rate of dividend and they are non-redeemable. So when they are non-redeemable, if there are declaration of preference dividend, which is the final preference dividend, just look in the statement here. They have already declared the interim dividend and paid them on somewhere during the year, which is 80,000. So now they are declaring an additional 80,000 final preference dividend. So this is the preference dividend payable. So it has been declared and it has not been recorded. So in terms of the journal entry, you will debit retained profit of AIDIL and you will credit the preference dividend payable by 80,000. So this will appear here in the consolidated statement of changes in equity, and that has to be deducted in the retained profit column of AIDIL. However, so let's proceed with the next one. The next one is the transaction that happened in the current year, because it says during the year. Fitri sold goods. So if Fitri is the subsidiary, it sold goods to the parent, AIDIL. So the goods at cost were 160,000. So the cost 160, and that was sold off for 200. Therefore, the selling price is 200. So that is going to give you a profit of 40. So this is the profit. And then you are informed that a quarter of the goods remain unsold by AIDIL. So the amount remain unsold is quarter. So you want to find out what is the unrealized profit. So the unrealized profit will be quarter from that profit, 40. So that will give you 10. So this unrealized profit is incurred by the seller. So for this transaction, there are two things that you need to adjust. One is the intercompany sale itself, which is this 200,000. Another one, I'm taking a different color. Yeah. Another one is this 10,000 figure. So for the intercompany sale, you're going to eliminate. So you're going to go and remove them from the sales, and you're going to remove the purchase from the cost of sale, because in the cost of sale it contains purchase. How much? With 200. So this will be done in our consolidated statement of changes in consolidated statement of profit or loss, right? And again, one more adjustment for elimination is the unrealized profit. So you're going to debit to the cost of sale, and that will be credited to the inventory. How much? With the 10,000. So that will be done later. So that will be adjusted in your cost of sale. Here you will add, and the sales will be adjusted, of course, in the turnover section. That will be reduced. Here it will also be reduced. The inventory will not appear because this is not preparation of consolidated statement of financial position. The next one, we move on to our goodwill. So here goodwill was being impaired, and if you look, you need to check whether the impairment is in the current year or prior period. So here this is in current year, since nothing informed. So that will be debited to the impairment loss. Impairment loss will be in your consolidated statement of profit or loss, and that will be credited to the goodwill with the 8%. So 8% times 300,000, that will be 24,000. So therefore, in your consolidated statement of profit or loss, this will have to be added, because debit is to increase the expenses. So you will add the impairment of goodwill more to the expenses in your Sopl, the consolidated statement of profit or loss. And that next one is the transfer to reserve. Transfer to reserve here is the transfer to reserve made by Fitri. When it is made by Fitri, it will not appear in the retained profit of Fitri, right? So it will appear in the transfer being made. The share of the transfer will appear in the retained profit of the parent, but it won't appear in the group statement of financial position that we show the transaction of transfer to the reserve by the subsidiary in that group statement. So that will be done by Fitri itself when that were being transferred. But for the parent, in the transfer to the reserve, there is also a share of the parent. So if you can still recall this that I have shared with you much earlier, I have the template or the format where for the transfer to reserve, if you look at this pro forma template that you have here, it will be the one of the holding, if the holding has, plus the group post-acquisition share in subsidiary. Let's say in our case just now, subsidiary transfer to reserve, the parent will have some share of that transfer based on the percentage of controlling interest, which is in the ordinary shares. So we will be doing that later, that part of transfer to the reserve, to show them the effect of the transfer here, right, in the consolidated statement of changes in equity. Okay, so that one will be done by doing this in the statement of changes in equity, and that will be done in the retained profit of the parent, where the parent company will incorporate the share here based on percentage acquired. Percentage acquired was 70% in the ordinary shares. So what will be reported by the parent as part of the group general reserve that were being transferred from the profit to the general reserve would be 40,000 times 70%. So 28,000 will have to be deducted in the retained profit of Fitri, retained profit of the parent Fitri, or the group retained profit. Next is on preference dividend. Fitri paid preference dividend that has been recorded in the finance cost. We need to see how much, to know how much. It is based on what you have here, 10%. So it is 10% from 1 million, so that was 100,000. When Fitri declare the dividend, which is the preference dividend that is redeemable, so the dividend that were declared, which is the finance cost, would be 100,000. Why 100,000? Because 1 million times 10%. So that was the dividend declared. So that is giving you the 100,000. However, part of this will be shared by the parent. So the amount shared by the parent, it will be based on the percentage acquired in the preference shares. So 30%. 30% from 100, you will have 30. So that has been recorded where? In the individual statement of the parent. So if you see here, preference dividend from Fitri, that 30,000 has been recorded, and this is an intercompany transaction, and this is what we need to remove later. So this one may need to be removed when you prepare your consolidated statement of financial position. So does this information, the professional fee to AIDIL, right? Professional fees to Fitri that will receive from AIDIL. Okay, that will be done later. Next is the information here which I have amended. This is the edited information that I mentioned because this is the edited version of the question. Just that particular information is being edited. The one in this rectangle box here, where the fair value or the value of the non-controlling interest of the subsidiary, I have edited it and make it to be at the proportionate share of the net asset, right? So earlier on it was at fair value. This is to suit the requirement of FAR320, which only focus on the valuation of non-controlling interest based on the proportionate share of the net asset. So that's just the information regarding the non-controlling interest that will be done when we calculate the non-controlling interest later. bear in mind this is the one on the date of acquisition. So this will affect the calculation of goodwill, but the goodwill has been calculated for you. In case the goodwill is not being calculated, you will need to do that. Next is the profit information. So you are asked to assume that the profit will accrue evenly throughout the year, right? So you assume that the growth or the increase in profit is steady throughout the year. If there is a loss also with it, there is no assumption there. Okay, number 9 is regarding the details of the equity. So this is just information about the different preference shares in the subsidiary as well as the ordinary shares as well. But here is the fair value of the share capital of this company. So let's look at the requirement. So we'll be doing that in our next video. We'll be doing the preparation and the also the preparation of the extract consolidated statement of changes in equity. And that will be in our next video. This is the video that only discuss on the workings. So we'll see you there in the next video. I'll see you when I will see you.